Hey guys, Joel Frank here, market analyst for YouTrading, and in today's video we're going to be taking a look at a couple of trade ideas that I'm monitoring at the moment. We're going to be talking about what's going on in markets, why I'm thinking about these trade ideas. So let's pretty much jump straight into it, looking at the charts here. Actually, I think I want to start with euro dollar, not the S&P 500, because basically in the last couple of days, and today as well, we're seeing an extension of dollar weakness pretty much across the board. We're actually seeing a bit of a pullback in US yields at the moment. This is helping risk appetite broadly. You're seeing stocks rally globally. You're seeing a lot of commodities rallying as well, like oil and other commodities. And that is all sort of feeds into and is related to this weaker dollar. Now, why are we seeing this trend in markets of the dollar coming off and risk appetite improving? Well, let's just go back to the calendar. We did talk about this yesterday, but just to remind you guys, we had US ISM manufacturing PMI data that was pretty weak, 50.9, below expectations for 52.5. It shows that whilst the US manufacturing sector isn't yet in contraction, it is stagnating. Now this is pretty much contributing to the idea that the US economy is really now starting to slow, which might, in 2023, if the US economy has fallen into a recession or is on the verge of recession, might deter the Fed from being quite so aggressive with interest rate hikes. Because you'd think that if the US economy is very, very weak, on the verge of recession or in recession, you would think that that would be a good helping hand in bringing inflation under control. Obviously, the Fed is primarily focused on inflation, and the message we've been getting recently and still from Fed officials is that they're still 100% committed to the idea that much more or a significant further tightening is required because of the inflation situation. But markets are kind of sniffing that there might be, maybe not a pivot coming, but there might be a point where the Fed is happy to indicate that, yes, this is how high interest rates are going to go, and this is where the end of the tightening cycle is going to be. I mean, in terms of what markets are pricing, money markets at the moment, you've got Fed funds futures at 4.37% in 4.41% next March, which seems to be roughly the peak of where markets expect Fed interest rates to go next year. Now that is down from nearly 4.6% at the end of August. At the end of September, excuse me, not the end of August. So markets seemingly pricing in a slightly less aggressive Fed as these concerns about the US economy and the global economy sort of come to the fore. Now, let's talk about the technicals here with euro dollar. We've been in this downtrend for a long time. I've been yapping on about it. We have broken some short-term resistance. We had these recent lows, and that was in the sort of 0.98 to 0.99 area, plus the 21-day moving average. We're above that. And it looks to me like in the short term, this little rally is probably going to continue until we test parity once again. We might even be able to nip above it, but I think we're going to test this downtrend and we're going to test that 50-day moving average. Now, are we going to break back above it? This sort of leads me to my trade idea. I mean, you've got to be prepared for these things happening, but I don't think we're really set up to break above this level, to be honest, guys, because what are the overarching fundamentals here? You've got a Eurozone economy which is underperforming the US economy. Looks like Germany and places like that are already in recession, or at least on the verge of recession, whereas the US isn't quite there yet. With the ECB, yes, they have had this hawkish pivot recently since August, but since August, Eurodollar has still fallen because that hawkish pivot from the ECB is still not nearly enough to make up for how much more hawkish the Fed is compared to the ECB. Now, things can be changing on the geopolitical front. Like we've had a lot of things happening in the Ukraine, in the war with Russia invading Ukraine. The Russians have been losing a lot of ground recently. So potentially, you could have a wild card, like suddenly there's negotiations and suddenly it looks more likely that there could be some kind of peace. That could be something that could trigger a break above this long-term downtrend, and then you'd be talking, if we did break above this long-term downtrend, you'd be talking about a swift rally back towards, well, initially 102, this resistance here, and then 103.50, this resistance here. But in the absence of a significant improvement in the sort of Ukraine geopolitical situation, the energy crisis sort of situation, there has been a pullback in European gas prices this week. But you know that Europe is still, you know, facing a very, very tough winter. In the absence of a significant improvement there, I think we're still headed lower, to be honest, for euro dollar. But something to watch. I certainly am thinking might be a nice area to add some shorts. But I would be keeping that stop loss tight because, like I say, this downtrend could easily go. Moving quickly on, so I don't yabber on for too long. Just as we've seen Eurodollar rallying, we've seen stocks rallying as well. This is a CFD which tracks the S&P 500. You can see it's broken above this resistance area here, which I was thinking maybe it wasn't going to be able to do, but all this weakness in yields, this weakness in the dollar, driven by weak US data, driven by speculation that maybe the Fed won't be quite so hawkish, has enabled this break higher. Now, I'm starting to think that, you know, if we're now going to be talking more about US economic weakness, the Fed potentially being a little bit less aggressive in the next couple of weeks anyway. I mean, we've got a couple of, how long have we got until the next US CPI actually? Yeah, the next US CPI is next Thursday. So potentially between now and next Thursday, if the US data, like Friday's jobs data and other releases, are weak, I think potentially we could be seeing equities rallying. We've also got expectations for quite a weak earnings season, which starts in the middle of this month. You know, if that is better than expected, then I think the stage is set potentially for a bit of a rally here. Maybe back to 4,000, which is where the 50-day moving average is. If we get above 4,000, maybe we can test this downtrend and the 200-day moving average. But anyway, in the very, very short term, I'm actually quite liking dips. I might, you know, be buying into this 3,750 area if we fall back to test it, or the 3,700 area to see if we can push a little bit higher in the short term. But I mean, things are going to be very data dependent. I mean, helping today's rally has been this weak JOLTS data. Look at this, 10 million versus expectations for 11 million job openings in the US economy. Still indicates strong US labour demand, but not quite as strong as we were expecting. Well, I mean, it is a big miss on expectations. And then you got ISM services PMI. If that's weak, that will help. Like I said, if Friday's jobs data is weak, that will help. I am thinking potentially that next week's CPI data could spoil the party if core CPI in particular remains hot. But you know, we're still talking more than a week away, so we're just gonna have to play things a bit shorter term. But anyway, guys, that's what I'm thinking on Eurodollar and the S&P 500. Hope you enjoyed the video, and I will see you all in the next one.